Most retail traders spend their days zoomed in on 5-minute charts, trying to catch a $10 price swing. Meanwhile, institutional money is moving ahead of a structural shift in the global monetary order. This trajectory is fueling institutional projections of a $3,000 price target for gold. Analysts are tracking this climb toward a juncture where interest payments consume enough tax revenue to begin dictating national monetary policy. When debt reaches this scale, it creates a state of fiscal dominance. In this scenario, the Federal Reserve is forced to keep interest rates lower than they otherwise would be, simply to prevent the government from going bankrupt. This chart shows the resulting mathematical trap. If inflation stays at 3%, but the Fed suppresses rates at that same level, the real return on your money drops to zero. If inflation spikes further, that highlighted gap represents a negative real yield. Gold historically thrives in this environment. Because it is a non-yielding asset, the opportunity cost of holding it completely disappears when the interest paid by fiat currencies fails to keep up with rising prices. By 2026, if the annual deficit continues to widen toward $2 trillion, the market will likely stop viewing gold as a tactical inflation hedge. Instead, it becomes an insurance policy against sovereign insolvency. While Western traders watch the daily noise, Eastern central banks within the BRICS nations are playing a decades-long game. They aren't just reacting to inflation, they are diversifying the bedrock of their national wealth. Recent global conflicts led to what analysts called the weaponization of the dollar. Foreign powers saw that holding U.S. treasuries exposed their reserves to the shifts of U.S. foreign policy, prompting a move toward assets they can physically control. This shift triggered record-breaking gold accumulation. When physical gold on the Shanghai Exchange trades significantly higher than the London paper price, it's a sign that actual demand is overwhelming the futures market, building a structural floor beneath the price. This diagram shows the breakdown of traditional market rules. Historically, a strong U.S. dollar crushed gold. But in 2026, we expect systemic stress to create a crisis correlation, where investors seek safety in both the world's reserve currency and gold simultaneously. Bitcoin is a digital alternative, but its volatility deters banks. In a true global crisis, gold has no counterparty risk, making it the preferred haven, while digital assets require power grids. This massive institutional demand protects gold from standard currency fluctuations. For a trader, it means the old correlations can no longer be relied upon to predict the next move. Understanding the macro trend is only half the battle. The primary challenge for most traders is simply surviving the time it takes for this multi-year bull run to reach its target. This is the cost of carry. Holding long gold against a high-interest dollar incurs a daily swap rate. A standard lot with a $25 daily swap costs $9,000 yearly, eating your entire profit before hitting the $3,000 target. Being right about the direction of the market is useless if you haven't accounted for the mechanical costs of staying in the trade. To map the road to $3,000, we have to look past the volatility of the lower timeframes and focus on quarterly and monthly macro charts. This chart traces the primary trend. By connecting the price bases formed during the 2020 highs and the 2022 lows, we can see the massive structure currently supporting the move toward 3,000. When we apply Fibonacci extensions to this base, the 1.618 level aligns almost perfectly with the 2750 mark, a critical breakout zone for the next leg up. Passing 2750 opens the door to 3,000. Traders should watch for profit taking at 2,500, followed by a media frenzy in the 2850 gravity zone before an eventual overshoot past the $3,000 ceiling. Be warned, the path will not be a straight line. Institutional players often engineer liquidity sweeps, violent $100 drops designed to trigger retail stop losses just before a major breakout. Chasing a breakout blindly at these psychological levels is a high-risk move. Successful traders often wait for a retest of the level to ensure the move is sustained and they aren't being shaken out by a temporary hunt for liquidity. The sovereign debt era requires a professional approach to risk. Use the FXNX economic calendar to track debt auctions and inflation data, and open an FXNX Pro account to access the competitive swap rates necessary for the long road to 3,000.